Hi, Ben Kogut here, CEO of Rooster Equity. I'm here with Andy Thelen with the Criterion Fund to talk about a three-property portfolio here in Texas that we are in acquisition of. So, Andy, thanks for taking the time today. Why don't you give yourself a little introduction?
I'm happy to be here, happy to kind of walk through this deal. I guess it's probably one of my favorite projects I've worked on since at Criterion and kind of since I've been in real estate. But yeah, my name's Andy. I'm the director of capital markets at the Criterion Fund. We're a real estate investment company focused mostly on multi-tenant community shopping centers. We've been around since 2019. We currently own about 110 million AUM, own about 1 million square feet of similar retail to this, and we've been active or have done projects in about 13 states. So this kind of fits what we do, and we're excited for it. And this kind of matches what we've done up in one of these markets already.
Got it. Got it. Well, let's talk for thank you for that. Let's talk for a second at a high level. What are the high level details on the properties, and then we're going to talk about the story, the background, how this deal came onto your radar.
So the portfolio, it's three assets owned by one individual who we have bought in from before. They all have below market rents, deferred maintenance. Guy's kind of a slumlord in some aspects where he doesn't put any capital back in, leaking roofs. The property we bought from them before had a collapsed roof where they couldn't lease some of the vacant units. And so our strategy is come in, put the needed capex, lease up the vacancies, increase rents 40 to 80%, which we've done previously, hold it for 5 years. We have a loan for all three properties, which is a great loan from Vista Bank, who we've worked with before, and find a way to stabilize these, sell them. We're modeling 5 years. It could be three, it could be two, it could be six. For simplicity's sake, we said all three sell at the exact same time in year five, just to not mess with kind of the forecasting. We think we can get very conservatively to a 13% investor cash on cash within probably 3, 4 years. The numbers you're going to see in this deck are kind of, I'd say, worst case scenario. We've blown these out of the park on what we've done before from the same owner and the same market, the same team. So, we're excited about this project. I think there's immense upside given what we've done before and just given how well they've performed since we've gone under contract on the deal. And we're excited for it.
Got it. Got it. Okay, so we're talking about three properties. We've done business with this seller before, and so I want to
Mhm.
dive into that. Before I do that, I forgot. We here's a little disclaimer for everybody listening. Please do your own due diligence. We're going to mitigate the risk as best as we possibly can, and we're going to disclose everything. And just want to let you know that here's our little disclaimer. So moving along. So here's our investment overview. It basically highlights what you talked about. We already have a loan commitment from Vista Bank. I believe you said that it also includes they're going to be lending on the TI that's needed as well for as this deal progresses. Is that
It's,
correct?
it's it's a neat loan. It's 75% of the purchase price, and then 75% of all capex, TIs, leasing commissions, and pursuit costs. So unlike most lenders that only want to lend on the stabilized value of the property for what you're buying it for, they're willing to lend all of the additional capex as well,
Correct.
which is great because I mean that's a big number, and they're fine with it because we're still covering like a 1.4 DSCR out of the gate. They're giving us 18 months to stabilize the property, even though we really don't need the interest only. It's great for cash flow and getting things done. And I think we'll probably really stabilize within 6 to 8 months. So hopefully we've got 12 months of just IO to cash flow this thing really well. 25-year AM is a nice portion of this deal as well. I mean, they're older buildings, so getting the 25-year AM versus the 20-year AM, I think, was a big win for the cash flow too.
Got it. Got it. Great. And so let's keep moving along. Let's take a look at the first property. So, oh well, before we get there, sorry guys, we're here. Here are the kind of highlights. We consider this the conservative assumptions. Andy, can you talk a little bit about this version versus this is the stress test version versus what we also think could be possible here?
I mean, so I'll use Victoria as an example. That center's got 40 tenants in it. We are assuming on renewals that we're only getting really a 3% bump in renewal rents, even though our broker who owns a lot of retail themselves down in Victoria was saying, look, you can take these $8 rents to $14 rents, no issues. We assumed you took that $8 rent to $8.50, and then you tacked on a 3% bump. And I think we can blow those returns out of the water. because those renewals don't factor in that we're going to be sinking $750,000, $800,000 in property improvements into the center. I mean, same thing with the Coronado and 31st Street. We own a center that's up on the northeast side, a little more in a rougher area, lower incomes. I mean, we've taken renewals from $8 to $14 for 7 years and 3% bump. So we took USPS from 8 to 14 and removed their termination clause. I mean, we've done 4% annual bumps, taking rents up to $16 to $17 a foot, in what I would consider to be a C center, where really these are closer to B in a much better part of town with access and visibility. So when I say stress test, we have beaten these renewal assumptions handily in a worse center with the same leasing team. And that's why
Yeah.
we said, okay, we're going to take longer to lease these spaces up. We're not going to get rents nearly as high as we thought we were. And to kind of justify it too, while we've been under contract, we've renewed and leased things higher than what we projected in our model under this assumption. So when I say this is very conservative, this is what I think it is. I think more on our base case, or what I think is realistic, we're pushing about a 16% cash on cash and about a 23 to 24% IRR. And the
Love
other
it.
thing too is that we have BOVs for all of these centers, and they say they should probably sell better than what we're modeling the exits on these deals too. And using 31st Plaza, which is here, this center is 100% leased since we've been under contract. Our numbers assume a 5% vacancy factor already. So that's 5% of additional income that we're not assuming we're getting. It's coming in right away.
All right. So let's talk for a second about this property on 31st Plaza. I know you had mentioned that you purchased a property from this same seller
Yep.
not too far from here about a year ago. And so maybe just, I think that's a really important part of this story here about why we're getting such a great deal, frankly, and how this is already a proven business model. And it's really something that I'm really excited about. So just talk a little bit more about that.
So the center we bought before is just called Martindale Center. It's on the northeast side off Route 66. We bought it. It had the parking lot was terrible. The pylon sign was falling down. The roof collapsed, so you couldn't lease three of the spaces. We went in, we redid the roof, parking lot, the pylon sign. We white boxed the vacant spaces. We had made all the tenant signage. In the 8, 9 months we've owned it, we've taken the NOI up 25%. And our latest renewal that's getting signed today as a 527 is Freedom Financial, which is taking their rent up from 30% with 4% annual bumps for a 3-year lease, and 4% is not standard. 3% really is. We took a medical tenant from 14 to 16 with 4% annual bumps on a 5-year lease. We took Fred Loya from 7 and some change to $14 on a 7-year renewal with 3% annual bumps. We just renewed another tenant from $8 to $14, or I think they were like $8.40 to $13.50. So you're talking another 60-70% increase in their rent. And all these tenants are fine to pay it because they were below market and they knew it, because the sellers doesn't really take care of his properties. And we put the CapEx needed that they wanted to see. And I think the other thing that's going to probably really benefit us too is we still have 2 leases or 3 spaces left to lease, which the parking lot's going to be done this week, which will probably allow us to lease them quicker. And once those are leased and renewals kick in October from some deals that we've already signed, without those leases, we'll be at a 15-16% investor cash on cash by the end of the year. So that's like basically a year of getting those returns to investors. And if we lease those vacant spaces up, we're probably going to be pushing 19-20% to investors, hopefully within 18 months of owning this thing, which I think is incredible.
Amazing.
We bought that at a 10 cap. This portfolio is being bought at a 10 cap. This one doesn't need as much capex. It's not as ugly as I'd say the other one we bought is. But there's still work to be done, and there's still upside, which is kind of why we love it.
Yeah.
I mean, that's kind of the story. I mean, we still have some additional upside we can do on that center. We've got a church that pays $6 scripts that we're not going to renew, and split that 6,000 square foot space up into 3 2,000 square foot spaces and probably get $18 a foot plus triple nets versus the $6 gross that church is currently paying. And I think once that's done, we'll sell it. And, fingers crossed, we return like a 35-40% investor IRR over 4 years to investors, which is phenomenal. So, ugly makes money. Ugly's not always pretty, but ugly cash flow is the best. Ugly's got demand. And we love this stuff. I mean, I think one of the core principles that we target, and it's kind of, if you want me to stop me, but we love this kind of stuff because you can't build new construction and charge less than $35 a foot to make the numbers work for any developer. And your triple nets on top of that are going to be closer to $8 to $12, especially in Texas when your property taxes are incredibly high for new construction. All of these tenants, if you kind of look at these rent rolls, are paying $10 to $15 a foot in rent. I mean, that's not a lot of rent that you can't replicate by going to a new site. So by the lack of new supply, it allows you to kind of push some of these rents. And there's certain tenants in here that we've already renewed and have converted a couple tenants to triple net leases. So we're already gaining that value and not paying for it. Um, we had and this center is always 100% lease. We had one tenant go out. We had a lease signed by Verizon within 2 weeks of that tenant going out. So
Nice.
it's an
Yeah,
ugly center.
we'll need to update the rent roll here pretty soon because that's happening in real time. Which,
Yeah.
frankly, I mean, typically sellers aren't necessarily letting a buyer who's under contract control and sign leases the way that you've been doing it. So I've been really super duper impressed, Andy, with what you guys have been able to accomplish in a short period of time. My question for you now is, when you look at these numbers and you're making assumptions of going from, you know, well, 15 bucks, you see subtle increases in rents plus triple nets. How are the tenants responding to that type of being pushed like that?
I mean, if you look at, call it Annie's Massage or Midwest Financial, you're taking them up 40 cents, 30 cents. You could probably push them $3 a foot. I mean, they know that there's no place for them to go in the market with these rents. The other thing too is one of these buildings has a collapsed roof that we're going to need to fix. That's caused some issues. So I think once you take care of that roof within the first 3 months of owning it, you now have a case to go to those tenants and say, "Hey, look, we fixed the roof. We really want you to. We're the new landlord. Fixing the parking lot, cleaning up the pylon sign. Like we're putting money into this, and we're actually answering your calls on a property management level when the current owner isn't. And half the time, just being present for these tenants is why it works. I mean, they just want someone that actually cares about their space. And whenever we do tenant interviews, I mean, the question's not always how much more rent can you pay. The question is, what can we do to improve your business? What complaints do you have about the center? How can we help drive additional traffic revenue to you? And I think that's what makes it a difference on how we approach deals. I mean, it really is, especially with these more smaller mom and pop tenants. It's a partnership. They're willing to pay more. They're willing to do the bumps if you're willing to justify why they should. And frankly, the renewal process is a whole lot easier than going through a national tenant.
Yeah. And I'll just add, when I walked this property with you guys and saw the condition of the property that it was in, which it was quite poor, and the amount of leasing activity that's still currently here, that I think is a testament not only to how great the location is, not only how great the rents are, but really this is like the purest of value add retail shopping centers I think I've seen in a really long time. So I
And
think
you've got
having,
great, and you've got
go ahead.
great traffic off that road, like 25, 30,000 cars per day. So I mean, you've got so much activity that goes by it. You've got a ton of points of ingress and egress, so people can actually come in and do their shopping. I think the other thing
Yeah.
too that's just really important to say, the reason why we've been able to get these leases done, like because we're not signing them, the current seller is still signing them. But Taylor Wellborn, who owns Wellborn Commercials, our leasing agent on both these two properties in Amarillo and our other property, he's a good friend of mine. He works with me while we've been under contract on what tenants should sign and what rents we're trying to hit in our projections and working with us to make sure we achieve what we modeled. And I think it's always a telling sign is Taylor is also investing pretty heavily in the project as well, and he's leasing them. And I think having someone that actually works on the projects, day in, day out, that leases it, that is going to get the bids, handle the construction management, that's willing to put his money where his mouth is, I think speaks a lot too on what he believes in the assets.
Amen. That speaks volumes, and I think that is a huge piece of this puzzle is the team that's involved, the leasing team, the management team, and the asset management team. Let's move on to the next shopping center that's also in Amarillo. When we drove, it was about 13 minute drive away or something like that. The Coronado Shopping Center. So if you mind kind of telling us what we're seeing here and what's the latest.
This center is probably the least occupied, but I think it has the most potential by far. You're on a lighted intersection that sees a ton of traffic. You've got an elementary school behind it. Your average household income is about $85,000-$90,000 in Amarillo. So your money goes a lot further up there. Our leasing agent lives actually behind the center. It has roof damage. It hasn't been maintained. It needs some new paint to be revitalized. But your average rent should be closer to about $17 to $18 a foot in this type of center with this traffic, with this access. So if you go back to actually the photo of the center, um, that C Mart or that big building, we plan on doing kind of a roof overlay and fixing that up. We kind of modeled the full replacement. I don't think we're going to need to spend that much money. We're going to paint it, do new pylon sign, clean everything up, new parking lot to make it pop, new landscaping, LED lights. That kind of gray building is an event center. I've already got someone that's interested in buying that corner because there's another road that runs right by it for them to do a QSR or some type of fast food use. So that's an immediate
Mhm.
upside if we can sell it off. We can go kind of to the center itself, and I'll run through kind of the updates on the rent roll. And that C
All
market
right.
is kind of like an Asian market where they sell durian and other overseas items. So it's kind of a unique market that does draw tenants. And if we go through here, kind of what I love. So we already had one tenant that left the site, Pizza Nomad. They were a 2 unit pizza concept. Within 2 months of them leaving, or a month of them leaving, we signed a brand new lease with a burrito concept that's got multiple units. The rent went from $12.75 to $18 a foot. That's a huge increase for the end cap space with us not doing anything. We've also signed a lease with a high end hair salon and we're not spending the TI money, the seller is. So that's going to draw a lot of higher end traffic to the building on the right side of the space. There's a Lego store, which they do kind of come in, birthday parties. It's a franchise concept. They're about to open. They've been under construction. That's going to be that's the bricks and minifigs. That's going to draw additional traffic to the center. And as you can see, their rent commences 6/1. So we weren't even buying it with that rent on the NOI, and we're going to get it day one, and we're not waiting for that spending the TI money the sellers. We've also got a barbershop supply company franchise that's coming down from Wolford Village where they're paying 25 bucks a foot plus high triple nets. We're working to buy him out of his lease to come down here. We've got a chiropractor that's waiting for their lease to expire at about end of the summer. She's already said she'll come over to the center. We've got an esthetician that wants to take 3,200 square feet of kind of the back end building because it's smaller and the rent's not as high, or her total rent's not as high. So we're working through that LOI right now. That's another 3,200 square foot of lease space. And this is before you do the facade changes, before you do the parking lot, before you make it look nice. And I think once you start making it look nice, you can start changing out tenants that don't do that great, that aren't the best uses. And what we do for tenants we don't love, so like if you go up to that Sigma tenant, they draw a ton of traffic, wear and tear on the parking lot. I mean, they're paying $16 a foot. I mean, our two strategies are: is you go in and you say, okay, if you want to stay here, you're paying 25 bucks a foot, which is more than anyone else. They bring a lot of 18 wheelers, which damage the parking lot. You're now paying for a larger share of the CAM charges than what your percentage is because you draw more issues to the center. And so it's okay, if we're going to deal with the headache of having them there, they're going to pay a lot more to make it work, or they're going to leave and we underwrote that they left and then we go lease it up. So it's kind of a win-win. We keep the rent coming in, we get a lot more rent than we projected, and we deal with the headache, or they leave and we go lease it up to someone else and kind of hit our projections.
Love it. Love it. Is there anything else you want to talk about on Coronado before we move on to the next one?
No, I think we're good. I love this center. I think this center's got the most upside. I think this is probably the best location of all the stuff. It's it's a little uglier right now, which is kind of what I love, and I'm excited to see what this kind of looks like.
Great. All right, moving along. And our third property is in Victoria, Texas, a couple hours south of Houston. Why don't you tell us a little bit about this one?
So this one's a little more unique. It's a ton of boutique mom and pop tenants. You've got 45 different suites. So this is going to be, I think, where you can add the most value because you've got so many different levers and tenants that you can pull and raise. So you can look on the outside. The facade's actually pretty nice on the front end. You've got one building that's got a collapsed roof in the back. You can see where that colorful stripe building is. It's to the left of it. One more to the left. So that building is behavioral health. So we've already got budgeted to fix the roof, lease that either to like a iOS company or a plumber or someone that needs kind of all the parking back there. And we can get a lot higher rent out of it. You've got a daycare that's been there forever. That's kind of one of the top rated daycares in Victoria. Victoria is very much an oil and gas town. The upside is you've got University of Texas A&M just bought University of Houston, Victoria, and so they're doing kind of a campus expansion right by here. A lot more oil and gas, a lot more kind of keeping those higher paying jobs in Victoria. You've got some refineries around here. You've got some people that are kind of moving out here because it's also cheaper to live than Houston. But this center is probably going to require the most capex. It's 103,000 square feet, so it's a big center. But I think that we can kind of really create a lot of value. And why this center works is you've got Navarro, which is the big retail thoroughfare where all the national tenants are. Your average rent in that thoroughfare is 20 bucks a foot plus. This center is 8. Your only 2 places to go if you're a mom and pop tenant is here or downtown. And downtown's kind of so this is where you want to go if you're trying to do a brand new concept, create something. You've got some tenants here that have been here for 20 years. They've been here, or maybe not 20, but 10 years. So you've got a lot of long-term tenants that are wedding boutiques, there's a bridal company, juice bars. I mean, you've got a lot of great users. And I think you can really capitalize on that by putting the money into the center and making it feel more community focused, especially where it is. And I think if you put the money in, you make it look a lot nicer. I mean, all these tenants kind of feed off each other. And then I think that's really where you can start pushing rents. So like you can even see on here, like this foot massage, we underwrote that their rents, their rent goes from $10 to $10.30 a foot, $9.50 to $9.79, $11.25 to $11.59. So when I say this is a stress test, that these tenants we have told can probably hit $14, $15 a foot if you put the money into it. That alone, you're looking like they're not huge numbers. And if you're a tenant and you're looking at these dollars, it's not a huge increase per month. It's a big per square foot increase. But when you're leasing 1,000 square feet, your dollar amount per month isn't drastically changed, which is why you kind of work. You don't quote tenants per square foot, you quote them dollar amounts per month. So that's kind of why I like this deal, is because all your rents are so low, there's nowhere for them to go. If they want to go up Navarro, they're paying double what they're currently paying here. I think you take them up and you make it just feel that much better. I mean, you're at a lighted intersection, you've got a ton of traffic. A lot of these tenants are great because they feed off each other for complementary uses. And there's nowhere else to go. And that's kind of why I love the center.
Yeah, I love it as well. Just so many small mom and pop businesses. And I remember when we were walking and speaking with the tenants personally, I think their eyes really lit up when they understood that, hey, there's going to be a new landlord who's going to actually care to invest into the property, to fix up the landscaping, to do the painting, to do the washing that's really needed on this property. It's just been neglected for so long. And I know that just based on that conversation, they'd be thrilled to pay a higher rent if they knew that they would be getting somebody who would actually care for the property, like what is within our plan here. So,
A current leasing broker told me he had 3 people sign renewals at higher rates with annual increases because they heard it was being sold.
love it. All right, so we're
So
gonna keep moving
and I
along.
think the
Go
other
ahead.
thing that's kind of just important to say too is I know you do a lot more single tenant net lease deals. And this is a little different because we're dealing with like 80 tenants between 3 properties. And kind of what I love is all these tenants are very small. I think the largest one you have is maybe 5,000, 6,000 square feet. In the event one of these tenants were ever to leave, you're not losing. You have the ability to release them. Most of these being mom and pop tenants, you're not really giving out TIs. It's more free rent, so you're not putting in a ton of capital. And these tenants are putting in the money themselves to be more invested into the space. So I think you've got a lot of diversity, a lot of protection by having so many tenants and by having the investment be across 3 properties. In the event one of the properties performs worse and another one performs better, your investments still even out because you are protected against 3 properties, 2 different sub markets, and I think that's important. And then real quick too, as we look at this aerial, so this building a little bit to the north, not that
Which
one, not
which one?
we don't own that one anymore. That one's
Yeah.
sold as an old flyer. That's a Mr. Gaddy's Pizza and event center that brings in a ton of traffic to the center. Then
Yes.
across the street, we have an oil change building or mechanic shop and restaurant. We're already in talks with both owners of these buildings to buy their businesses or buy the buildings themselves at a 7.5 cap rate. And so that
So
would
it's
be an
a
immediate pay down of debt and return of equity within the first year. We quoted them 7.5 cap rate. We're buying the whole thing at a blended 10. So you're looking at a 2.5 points of arbitrage opportunity just to sell these off to the tenants. So we're
so to
currently working
clarify,
through that right
yeah, the tenants that are occupying these buildings, one, this is the restaurant and this is the oil change place. So there we're in discussions for them to purchase their own real estate so that they will have control of it. And so what's going to happen when that, or if and when that occurs, Andy? What are we going to do with the capital when we sell, if and when we sell these two properties?
So it'll be a 75% pay down of debt and a 25% return of equity. So that's kind of what we've negotiated with the bank. And it'll be the same thing whenever we sell off any of these deals. The majority of the funds are going to be used to pay down the debt, and then but some will be used to return and pay back equity.
Okay. All right, moving along. Yeah, so we'll have we're not going to go too deep into it on this presentation, but we have a deal room that has all this information, maps, all that kind of stuff. Sales comps, we can touch on this real quick. Is there anything you want to say about this
I mean, we're
or about
assuming we're
the
selling Coronado in Amarillo at an 8.5 cap rate. We're selling 31st at a 9. You can see those are both well above the averages of what stuff's selling kind of in West Texas. And Victoria, I think we're assuming an 8.75 exit cap rate. So that's about 60, 75, 60 bips conservative underwriting. And I mean, I would
nice?
argue we're probably a better market in several levels in there.
And
And
similar,
here's kind
here's
of the
some
leasing
lease
comps.
terms. Hmm,
Here's kind
go
of the
ahead.
leasing comps. You can kind of see why we can justify what we're doing. I mean, you can see we took Comfy from 1150 to 16, USPS from 7 to 14, AMD from 14 to 16, but this has 4% annual increases. And Fred Loya was a huge increase. We signed this new lease at $15 a foot, no TI as is, 1 month of free rent.
Hmm.
So here's your Wolfland's your larger center that's about 5 minutes to the north in there. And I mean, they're getting 20, $25 a foot in rent, and we're not trying to get close to that. And their triple nets are probably double what ours are. And you don't have great visibility at half that center. If we drove through, you kind of face in it, and you don't have the visibility from the main road.
Love it, love it. Same thing in
And then here's
Victoria.
here's the proof for Victoria. I mean, your average rent's 1930. I mean, we're at 8.
Yeah, love it. Love it. Okay, great. Let's hit some of the high numbers here and the financial summary. What should investors expect? And also tell us a little bit about, we haven't talked about, we've had some professional appraisals done. You've mentioned BOV, but the professional appraisals, what are we seeing from a financial summary?
I mean, on the as is basis, we're buying it for a lower price than what the as is items are, and on the stabilized, I think with the exception of Victoria, we're selling this. No, Victoria was higher. We're selling these two of them higher than what the stabilized value of the appraisal is. The other one's kind of in line or a little bit less, but I think 2 out of 3 with an appraiser is pretty good.
Mhm.
And then
All
in terms
right.
of the cash on cash returns, just going back one slide, again, these are kind of our conservative assumptions that I think will be pretty handily. You're still going to get an 8% distribution, and these are to the LP. This isn't project level. So that 822 is what the LP will get year one, and then it'll keep increasing. I think if we do this right, you're going to be looking at close to like a 15 to 18% cash on cash when it's all said and done.
And these are quarterly
Quarterly, yes.
distributions? Yeah, so just for everyone that's been investing in my deals, we're usually doing monthly. On this one, we're doing quarterly distributions. So just heads up on that.
Yeah, there's
All
just
right.
too much to keep track of, and we kind of like to assess each quarter to make sure that everything's in line and collecting rent in a timely manner from 83 tenants. There's going to be a couple that are a few days late, so we try to.
Makes sense.
It's going to be a pretty big undertaking just to manage this many tenants, and I think we've got the right team to do it, so I'm excited.
Got it. And here's our sources and uses details. These are some big numbers. So let's just kind of talk through these. How did you come up with these numbers? Do you already have hard bids? How close or, accurate do you think these budgets are?
So these numbers are probably higher than what we're actually going to get. I'll use Coronado. That's a full roof. I don't think we need to do a full roof repair. I think we can probably do more of an overlay. And we're also going to be bidding Coronado and 31st at the same time, trying to get some pricing discounts for having two deals. Taylor Wellborn, who has a construction company, leasing guy, has his own crew. We ran through all of these numbers and we said, okay, what do we think the most is that it's going to cost? Because we showed that to the bank and put that in our numbers to make sure we had something to beat it by. So we technically go hard on our money today, so 527. So now that we're moving towards the closing process, we are going to start actually getting bids so we can start with day one. It didn't make sense to spend their time to go get bids before it was guaranteed that we were going to close on the property.
Hmm.
Victoria, John Kilpatrick, who's the current leasing and manager of the property, he owns his own construction company. He sent out a detailed breakout of every single thing that he would do to it. These aren't just all bids. These are kind of more stuff that he's worked on before. And frankly, and if they come in higher, we don't have to do them all right away. Like we don't have to do the security cameras day one. The TI number is a very high number that we probably won't have to use just because these are going to be more as is deals. And frankly, with this being a portfolio deal, if one's higher than the other and we have savings, like I expect we'll have in Coronado, we can take those savings and use them for another project. And this will be one investment for all three.
Love it. Love it. All right, moving along. If you want to just kind of touch on these, or people can read this on their own. I don't know that we want to go too deep into this on this visual presentation, but is there
Yeah,
anything you want to mention about these projections?
the way we did it is we assumed that if you go through it, there's three roles. We did a cash flow on each three projects, so you can kind of see how the NOI increases. So you saw it for 31st, Coronado, Town and Country. I think we'll beat these. You can see we've got a 5% vacancy factor and everything, and then we've got a portfolio roll up of all of the cash on cash, kind of what the splits are. Our DSCR, we're at a 142 right at the gate, so we're very well protected. It gives up to a 179. And I think the biggest thing that's going to determine some of these returns is when do we sell the centers? Because we assumed we sold all of them in year five, just in one transaction. And if we sell,
Yeah,
call it Victoria, and we stabilize it fastest, that's the largest sale. If we sold that and returned half the equity, your cash on cash goes up through the roof because we returned most of the money. But we just didn't want to play kind of a financial arbitrage game of saying, well, we sell this one in year two and this one in year four, because we have no idea. We don't know how long it's going to take to stabilize. We have an idea, but we figured just to protect returns and protect against downside, let's go ahead and assume they all sell in year five.
correct.
And
Yeah. So
then, yeah,
this is
here's,
a bear case, bull case
yeah, and
scenarios.
in 31st Plaza, my BOVs are at 8 or somewhere around there. I think Ben, you can share. I think I have something to do with Sandscape to me, but like, we're very conservative on our exit cap rates on these deals. I think we can beat the exit cap rates. I think we can beat the cash on cash. I think we can beat the renewals. And so I feel very confident that these are kind of as I said, a stress test.
Great. Got it. Got it. Okay. Well, let's keep moving along here. We'll just talk about the team on your side real quick.
These are the four of us at Criterion. We've got about another 4 or 5 employees based out of Tulsa. I'm in Fort Worth with Jackson, who's kind of the VP of Capital Markets with us. The team for these deals is we've got Joel owns another company, Precision Equity. They will be handling the accounting for the two Amarillo deals because they currently do that for our other project. And then Taylor will be kind of the boots on the ground maintenance repair guy. Leasing, and they kind of work hand in hand. It's worked out great and kind of keep that going for the other two deals. And then for Victoria, we'll have Brian Ferguson will be our leasing agent who owns a bunch of stuff down in Victoria, kind of knows the market, knows half the tenants personally. And then we're going to be using Transwestern for property management and accounting, who currently manages our grocery anchored center we have in Houston. And he's got a couple projects in Victoria, so it's not that far of a stretch for him.
Great. Got it. And you kind of already touched on this. More of this is on your website, on Criterion's website. We're going to provide some case studies as well. I mean, these are pretty relevant. Well, proving what you guys have been able to do, especially this Martindale Plaza that I personally visited with you guys as well. So all this is available. Here's a little bit about me and Rooster Equity. We're raising three out of the $5 million on this project, and yeah, this is here. I'll be raising the capital, and I'm your liaison between me and Andy. Although if Andy needs to be available, I'm sure we could be, but you'll come to me, and I will be representing all the investors on this project. And this one is a great fit for our portfolio because we've been looking for the right team, the right multi-tenant value add opportunity. And we looked at about 1,500 deals before we agreed and came to the conclusion that this was going to be the next property we wanted to participate with. So we're very excited and grateful for the opportunity to partner with Criterion. Andy, is there anything else, any other closing thoughts that you want to share about this project?
I mean, I love this project because it's something that we've done. It's something we've executed with the same seller. I love the upside. I love that we can our downside projection still an 18 and a half IRR. It's still over two equity multiple. I mean, I think it's a safe, not necessarily everything has risks and challenges, but in terms of the amount of tenants, the locations, how well we know the properties. I mean, I'm excited for it. I love these deals. I think it's going to be a fun one. I've spent way too much time in Amarillo, which is fine during the summer. It's like 20 degrees cooler than Fort Worth, so I'll take it. But it's it'll be a cool project, and we're really excited about it. I love our lender. I love the team. I've been working on this project for probably about 5 months, so it started with trying to buy like 8 deals from this guy, and then we whittled it down to these three because it made sense in terms of what he needed and what we needed. So it'll be a fun one.
Great, great. Well, I'm very excited as well. If anybody's interested in investing or has more questions, you can reach out to me personally or through my website, roosterequity.com. We have a deal room set up, and yeah, really grateful for if you got it to this far in the video. Thank you so much for taking the time, and looking forward to investing together as partners. And with that, we'll wrap it up. Thanks again, Andy.
All right, thank you, Ben.